Hey, good morning, everybody, and buckle up. You know what time it is. It is Saturday morning, and this is Multifamily Unplugged. Hey, something totally different this week for you. I did a Q&A webinar earlier this week with Aaron Fragnito of People's Capital Group, and we had a number of people on. We took questions from the audience. Aaron and I asked each other questions back and forth, talking about the state of the multifamily markets, the state of the business right now, what we're looking forward to moving forward, what the new year will bring, what the change in environment will bring. So it's really a great episode. So I thought this week it'd really be great to go ahead and reshare that on Multifamily Unplugged. So I'm glad that you're here this morning. Hey, if somebody's not here, go wake them up, stick a cup of coffee in their hand, get them over here, because they're going to really enjoy this episode. You're going to want to sit back, take some notes. A lot of great content, a lot of great insight. Remember, I have just started a brand new group coaching program. If you are someone who's looking to get involved in the multifamily business, you want a little bit more insight, I have a great offer, great opportunity for you, either on a weekly basis or you can join for a lifetime for one low investment. And I just want to float that out there. If you have questions about it, don't hesitate to reach out to me and let me know. Remember, live intentionally, live your life with intention. Get up, build into your intentions on a daily basis, and build your multifamily business, build your real estate investing business. Be awesome at what you're doing. Hey, everybody, I hope you enjoy this morning's episode. And here's me and Aaron as we talk about the state of the multifamily market and get some questions answered for you. And if you have questions beyond this, by the way, don't hesitate to reach out to me on email at mike@mycoreintentions.com. I'll be more than happy to see if I can't help you with those. Talk to you soon.
Going to speak about how to earn mailbox money, passive income through a recession, which we're kind of experiencing right now, depending on who you ask, of course. Yeah. And so we have about a dozen questions or so that we're going to be discussing tonight. And I want to have Mike on the show because he also is a real estate syndicator, but in different parts of the country. And we have different strategies, but in a sense, we offer a very complementary services. So I wanted to bring on the show. How are you doing tonight, Mike?
I'm doing great, Aaron. You're not kidding when you talk about that we might be in a recession, depending on who you ask and what part of the country we're in right now. But everybody seems to have a different opinion about it, and a difference in where we're headed in the economy. So I know I have mine, that's for sure.
Sure, absolutely. It probably depends on who you voted for too, if you feel like we're in a recession.
Yeah, well, let's not go there tonight, Aaron.
Everything's political these days, even economics, right? So it is what it is. I did vote here. I got my voted sticker, but I won't tell you who I voted for. It's top secret. All right. All right. So anyway, so let's get on to our topics here tonight. Mike, why don't you give yourself a quick introduction so our viewers know who you are?
Sure. Thanks, Aaron. I'm Mike Morawski. I have a company called My Core Intentions. I'm out of Chicago, Illinois. Been in the real estate space for about 30 years. Started out on the residential side as a residential sales agent. Came from the construction industry, went into the residential business. My first 9 months in the business, I sold 78 single family homes. Went on to build a team selling 125 houses a year. Did that consecutively for about 12 years. 2005 showed up and I saw the market was starting to soften. Knew I would have to go do something else. Wasn't exactly sure what I should go do, but I knew that the market was going to change. Always had wanted to go into the apartment business, the multifamily space. So I thought this would be a great time to go syndicate a multifamily deal. Knew nothing other than the fact that you raise private money from individuals, you marry it with a great real estate deal, you stay in the middle, and as long as everything goes well, you make money. So I syndicated my first deal in 2005. Over the next 30 months, I raised $18 million, bought 4,000 apartments in 5 U.S. markets, vertically integrated a property management company managing 7,500 doors. And today I'm in the coaching and training space. And I work with multifamily investors, helping them scale their business, teaching them the strategic steps, how to build their business, and wind up partnering with some of my clients, and we syndicate multifamily apartments. Focus mostly in the south east of the US. If you looked at a map between Dallas and Charlotte, those are the markets that we really like.
Yeah.
And we'll get into, I know we're going to ask each other some questions, but we'll get into a little bit about why we really like the markets that we like. So how about yourself,
Sure.
Aaron?
Sure. Excellent. Excellent. Yes. So I actually started as a realtor as well. That's a great way to start in this business. I got my license in 2010, entered into one of the harder real estate markets to sell houses in, and quickly learned that to make any money in 2010 as a realtor, you pretty much need to understand short sales and REO properties. And that was fine with me because my path was always to own apartment buildings and own commercial real estate and really all types of real estate. I read a book called Rich Dad, Poor Dad, of course, in college, actually, after my 4-year college degree, 6-figure college degree. I read a book for about $9 that completely changed my life. So, I decided to get my real estate license and start with wholesaling and stapling signs to telephone poles to say we buy houses. Got my first deals that way. I started a real estate association as well, Real Estate Investors Association, called New Jersey Real Estate Network. And I was able to build that up to about 4,000 members now today. Through the years, my business partner, Seth Martinez, and I, we teamed up around 2013. We've fixed and flipped about 50 houses. We wholesaled about 100 properties and done about 250 transactions, 9 syndications. And we're vertically integrated here in New Jersey. So we have an in-house property management company. And what really sets us apart from Mike here and your company is that we just focus on New Jersey. We're very locally focused. So we'll talk about tonight, big topic. I'm sure there'll be reasons to invest in different areas and then reasons to stay local as well. So we'll discuss that tonight. And, I really now focused since about 2018 on the syndication space and helping people invest in real estate. And it's a lot of fun. We are people's capital groups. We help people invest in real estate. I was talking to a teacher today, a school teacher. I was also texting with a sheriff. It's amazing who ends up investing in our fund. It's a 506B, so we can accept sophisticated investors also who are non-accredited. And there's some challenges with that on a fundraising side, which we can address. But it's fun because I get to talk with so many different types of people in a day, multimillionaires and people just getting started investing, looking to build wealth to the next level and diversify out of the stock market generally. So that's what we focus on doing here at People's Capital Group. And we've been doing this about 10 years. So we have a nice portfolio now, about $20 million in assets, about 150 doors throughout New Jersey. And we're building that every day. So wanted to have you on the show here and go over these questions and kind of give our viewers a taste of different strategies for real estate investing and different ways to build your wealth. And neither one's right or wrong, really different strategies in real estate. And boy, there's tons. We can't even go over all of them between short-term rentals and fix and flips and wholesales. But for the most part, what we'll focus on tonight is real estate syndication, which for our viewers that don't know, that's when we pool capital together and we buy an apartment building, generally with limited partners that have no voting options and are passive investors that are getting generally monthly updates, quarterly financials, and cash flow checks, but they're not making day-to-day decisions, nor do they have the responsibility or the power to do so. And that's kind of where what they want to do. They've professionals like Mike and ours company to put their capital to work in good opportunities in the real estate market, manage that long-term to get the project to completion, whether that means selling the building or refinancing it. And that's exactly why real estate syndications exist.
Yeah.
Because, I got my hair cut the other day. I didn't do it myself. I went to a barber, right? So that we hire professionals for the things we want done professionally and properly. If I did cut my own hair, you'd probably know it. Heck, I don't think it would look so good. So, at the end of the day, that's what we hire professionals for. And, but yeah, Mike, I'm excited to get into it tonight with you.
Yeah, me too, Aaron. And one question I want to ask you, how did you go from nailing signs up on electric poles on the corner to passively investing in real estate, or having other people passively invest in your real estate is really the better question there.
Sure. That was a challenge. It absolutely, I was selling so much real estate and I was getting good deals, and I was therefore surrounded by people that were investing in real estate. So a lot of those people that were buying properties from me, some of them I converted into passive investors as well, but those are actually pretty difficult individuals to convert into passive investors because they have all the means to be active investors, although sometimes they get to a certain age and they're ready to kind of slow down, become passive. The main way I raised capital, from a guy stapling signs to telephone poles to buying apartment buildings, was doing my RIA. And basically what we focused on is building that network and just having more and more people come into that network. We used to do events in Morristown and different places, and that's allowed us to really grow our brand. Now, the pandemic definitely slowed that down. We pretty much moved everything online, but for the most part, we've been doing very well with just continuing to build that group out, team up with other groups as well. And I saw here, Mike, that you said my connection's a little slow. So let me just try to okay. It looks like our connection's a little slow here, not airing out properly on YouTube. Let me just delete a couple or exit out of some of the groups as well. Boxes here. And I saw here, Mike, that you said my connection's a little slow. Oops, let me just X out of this here. Hold on one sec. Little technical difficulties here. We'll get this fixed up. Time. Let's see if I X out of everything, if that gets us where we need to be. All right. Okay, Mike. Well, hopefully you can hear me a little better. Can you hear me fine on your end, Mike?
Yeah, that's good. We'll see how you go now as you talk a little bit more. So
sure, absolutely. Well, let's break into these questions here. Oops, I just X'd out of the questions. I don't have them in front of me. Why don't you go ahead and read the first question? We can start our list there.
Yeah, well, like I had asked, how did you get started offering passive investments to other people? And, you were kind of talking about that a little bit.
Mm-hmm. Yeah, and that was it. I went to a RIA. I went on meetup.com and I made a beeline for the owner of the RIA. And I said, hey, I'm a new realtor. I have 14 short sales. Started in this business, and I want to talk about how I got my first 14 short sale listings. And it was pretty cool because I had a good story behind it. I had called a lot of expired listings and said, hey, your realtor did it wrong. Because what realtors used to do with short sale was list them at what they owe to the bank. And it never made any sense to me because the whole point of it is to short the debt to the bank. So you listed what the property's worth or what you think the property's worth and what buyers are going to bid at. So we're even a few ticks below that to get a bidding war going. And so that I knew how to do short sales. I learned how to do short sales. I actually took a course on it. I paid like $1,000. I'm not sure if the course is worth it at the end of the day, but hey, it got me to where I am now. So, that helped me kind of get started there. And that's what I specialize. Short sales. I work with a short sale negotiating company. I learned how to wholesale short sales as well and work with them in different ways using LLCs. That was my specialty getting started. So that was my niche. I learned distressed property and how to acquire them. And that's what I spoke about. And at the same time, I was like, oh, by the way, I'm going to start investing in these properties. I'm opening up to investors. And I paid them an 18% interest rate to get started. That's what I did.
Well, interesting. I loved short sales when I was selling real estate because I love that piece about negotiating with the bank and just negotiating back and forth. And it really taught me a pretty valuable lesson in that short sale space. You have to be patient when you're doing that because you're not going to get an immediate answer from the bank. And it really taught me that piece about patience being in this business. And it's interesting because even today I'm negotiating an LOI on a 200 unit apartment deal that we're looking to put together. And the seller's just dragging his feet. And it really has brought that patience piece to the forefront again about just slowing down and just waiting, I love this, and I just want to chat a little bit about how I got started. And I always tell this story because it's not duplicatable. You couldn't duplicate this today. So I was selling real estate, working with a lot of investors, doing short sales, doing fix and flips, things like that. And I decide to go into the apartment business. I go and I buy an 11-unit apartment building. I put it under contract. And then I go, oh my God, where am I going to get the money? So I knew I had to go raise some money because I was going to get the bank debt. The bank said, do you have the money? I said, yeah, I have the money. Don't worry about it. And I knew I needed to go raise the capital. So what I did was I put a little classified ad in the newspaper. I spent $45 for 3 lines. It ran for 5 days. All that ad said was real estate investors wanted. And my phone rang off the hook for like the next 4 or 5 days. And as a result of that ad, over the next 7 months, I was able to raise about $600,000.
Wow.
We did that deal, and it was a good chunk of money to go and do the second deal that I did. So I say it's not duplicatable today because there's not newspapers that get that traction that you would get in the classified section of the old local newspaper.
Sure.
Everything's done online today. But, hey, that was the best $45 I ever spent in my life.
It's crazy. It's really interesting. Marketing is funny when it works, like that. And you're like, wow, you feel like you hit a gold mine.
Yeah.
Like you tapped into it and like, oh my gosh, no one else knows about this. I don't want to tell anyone else about how I do this. I remember when I was first getting good deals too. The We Buy Houses signs I put on telephone poles was really a lucrative, great return on investment. The signs $100 for a box of 100 or whatever it is. So, putting them up was a little bit of a pain in the neck, but yeah, the phone rang a lot. In fact, it was funny because I had a friend who had paid for a number to get started, the phone number we had on the signs. And I thought he was going to continue to pay for it, but he didn't. And I was putting up signs, the phone was ringing, and then all of a sudden it stopped. And I was like, wow, what happened? I know I need to put up more signs. So I bought more signs and put up more and more and more, and the phone's not ringing. I was like, oh no. And then I called the number one day. I was like, oh, that guy stopped paying for the number. Okay. So I learned in that, way, make sure your systems work instead of just pounding your head against the wall. But, absolutely, and then we got the number up and running again, and it started working again. But, yeah, when you tap into that market with that early marketing strategy, it's really incredible. And me, for one, I'm actually in the midst of also now developing different marketing strategies, whether it's YouTube or social media or SEO marketing or paid ads. And those are all pretty saturated spaces. As I was telling you before, I took about an hour this evening and I looked into building my YouTube channel and just kind of how to do that. And it's incredible how saturated that space is and what you're up against in the private fundraising industry. I feel like everyone now owns a real estate syndication. It's like the new popular thing to do. Where, boy, when I started real estate syndication in 2014, no one was, there were some people doing it. There was like Joe Fairless, like he was teaching it, but it wasn't really the space it is now today. And one of the things I regret doing was not going heavier into the space at that time. And I was really focused on a lot of other things, flipping houses and wholesaling. But there's a lot to be said for a space that's kind of untapped like that, the syndication space, private capital raising. And there were some laws that changed from the Jobs Act in 2013, which made it a lot easier to raise and pool capital. And still today, those laws are in place, which makes it easier to raise and pool capital. But man, I should have recognized that untapped space and stuck with it a little more so than altering off to different parts of real estate. I think that was a correction I learned over time to be a better business owner in that sense as well. But just a fun little story there.
Yeah. Well, Aaron, what's interesting is you think the space is more saturated than it really is because we live it every day. Right. And we run in this circle of people where we know each other, we see each other on social media, we're on webinars together, we talk to each other. But really, when you go outside of that circle of people that we know or who we do business with, there's a whole world out there of people that don't know how to invest in real estate.
Mhm.
want to be in real estate because they know that there's some safety in it, there's some ability to make money, to get rich in it, but
Mhm.
they don't know how to get started.
Mhm.
And that's the people that your marketing needs to tap into,
Yeah.
whether it's YouTube or whether it's some other social media platform. And the other thing that you said that was really interesting was strategy, right? So let's talk about this for a minute. Talk about what you like in the asset class that you buy. What's your strategy around that?
Mhm.
And why do you do that?
Sure. So we like to buy apartment buildings that have value add in New Jersey. Now, first of all, the reason I like apartment buildings is because people need a roof over their head, whether there's a recession or not. And as home prices get more expensive and interest rates go up and it becomes less affordable to own a home, more people seem to be renting. And so that's a good space to be. Secondly, New Jersey, there's way too many people living here and there's not enough space. It's the most densely populated state in the country. We have a lot of high-paying jobs, well-educated people, great workforce here, but it is hard to build new real estate. If you want to develop an apartment building in New Jersey, good luck. There's a lot of red tape. There's a lot of capital requirements and so on, like there is in any time you're building a ground-up commercial piece of real estate, but particularly in a blue state, it is difficult. So because of that, there's a shortage of housing. There's a serious barrier to entry in this market. There's a lot of companies that the syndication space, are focused on different markets, red states instead of blue states. And that means there's a little less competition here as well. But I really focus on value add. So above all things there, you can make money in different types of real estate in different states and markets, but value add is the most important thing no matter what. And that means, rents are below market value. There's things you could do to the building to improve it and collect a higher rent roll, making a more desirable building.
So and let me just say this real quick. If there's anybody on the webinar tonight or YouTube, if you have questions, throw them in the Q&A. We'll try and get those questions answered for you in the next 30 minutes or so. If not, you can always reach out to us afterwards. But Aaron, when you talk about value add and somebody new might not really know what that means. Are you talking just about the physical component of value add where maybe you would go in and do some construction or some rehab upgrades? Or is there other types of value add that you can bring to a apartment complex, apartment building that would create value?
Sure. So we look at everything. I've looked at an apartment building that had a gym that was being held to use construction material for the seller. It had his and her locker rooms. It had 4 saunas, and all it needed was a clean up and some fitness equipment put in place, and boom, you'd have yourself a really nice gym. And through that, you'd attract better quality tenants. Maybe you could even charge for the gym, or you could include it in the lease and just attract better quality tenants and charge a higher lease. So that's a perfect example of value add, easy value add, obvious value add. And now when we first looked at the offering, that wasn't necessarily front and center. We kind of had to do some digging to find that. So value add isn't always so completely obvious as rents below market value. Now that is the most common thing we look for. Of course, generally, if a building is disrepaired and mismanaged, the rents are naturally kind of low on it. I'd be amazed if they're getting high rents. That's not really what we're looking to purchase.
Yeah.
But you also want to make sure that the low rents are reflected in the price, right? For years, we've been told by brokers and sellers that, hey, I know my rents are 35% below market value, and I know you can increase them by 35%. So I'm just going to price it at the price, assuming you've already increased the rents to the 35%. It's like selling a half-broken car and being like, I know after you fix this, it's going to be worth a lot more money. So I'm going to need you to pay the amount of a running car, even though this car is not running properly. It's just still silly, but that's been the seller's market we're in. And brokers and sellers assume you're just going to pay the price of the renovated, property with the full lease at full market value. But you need that discount worked into the price. You have to buy for a discounted price, but sometimes you do have to pay to play a little bit. And we find ourselves in high demand markets, sometimes paying a little bit more than we'd like. Well, really, always more than you like, but a little bit more than, sometimes we underwrite, or we have a variation, a variable. We say, okay, here's the price we really want. Here's the price we're probably going to pay. And here's our top dollar. Now that top dollar price still has to work regardless. Right. But we do find ourselves sometimes reaching that top price just to get the deal done. Now, of course, it's a price that works. So we never go above that. But I'm looking forward to a market where we don't have to stretch on offerings,
Yeah. Yeah. Makes a lot of sense. I like what you said about uncovering that workout room or fitness center in a building that they were storing things in, right?
Mhm.
I love adding amenities to a property, right? And creating that additional value, because you can raise rents as a result of it, or you can create more revenue as a result of it. We just bought a 40 unit in Tampa, Florida, and out in the back of the building was this old shed that they kind of used for an office and storage.
Mhm.
Well, we gutted it. We fixed it up, the inside and the outside, painted it, put a new roof on it, opened a wall, there was electric and plumbing already out there. And we built a laundry room.
Nice.
The property didn't have washer and dryer hookups, didn't have a laundry room. We put in a laundry room. We actually partnered with a local vendor who brings the washer and dryer in. They take care of all the repairs and maintenance, and we collect, we get a quarterly check for doing that. And our only investment was cleaning up this room, basically. So,
Mhm.
There's different ways. The other way that I really like adding value, Aaron, is operational value. A lot of times you can find a property that, the manager's tired. They're not really running the place like they should. The traffic pattern for tenants coming and looking at properties is bad.
Mhm.
The rents are low, and you can push rents. So on the operational side, sometimes the expenses on a property are so high, you get expenses in order, raise the rents a little bit. You don't even have to spend a lot of money on capital improvements,
Right.
but it's all operate on the operational side. So that's always interesting.
Mhm.
Hey, let me ask you this: is passive investing more about creating wealth, or is it about giving people a vehicle that they can maybe get some cash flow from and protect their principal? How do you look at the passive income side, or passive investing side, I should say?
Yeah, well, really, the goal of any type of investment is all the above, right? First and foremost, as they say, don't lose money, right? And that's why people like real estate generally, because it is tried and true. It is backed by a brick and mortar asset. And that allows, often in high demand markets, well-managed real estate that you can buy for a discounted price with value add. That's a really safe place generally to invest. And as long as you're with the right operators, it could be a very profitable investment as well. Obviously, you invest in anything to make a return, so it has to beat inflation and it has to grow consistently, and ideally in good markets and bad. So I think real estate is nice because it's not like necessarily investing in a stock or something like that, where a stock can go down to zero. Even a good company can go down to zero. Generally, real estate, something has to go extremely wrong, like you didn't have the building insured and it burns down, which again would go back to working with the wrong operators, for you to lose your investment entirely. I've had challenges in real estate where, I had a property that got struck by lightning 4 times, right? And we had to make an insurance claim. We made out like bandits. We got like a huge check from the insurance company. We sold the property to a contractor for like more than we were into it for. We made a profit on both ends. It was like a huge windfall for our investors and ourselves. And it was just, it's funny. So if you do real estate the right way, you're properly insured. It is a very safe investment in the long term. But we've also made pretty incredible returns as well, like 24% annualized returns this year so for our investor group. So, it could be very profitable also. People tend to look at real estate and they say, oh, it's not like an aggressive investment. I'll probably be around 10% a year. And that's a safe assumption. And that's a good accomplishment to be around the 10% cash and cash return annualized. But man, it's really possible to do even better than that in real estate if you're with the right operators and with the right strategy, and doing the right tax strategies as well, as we do with the buy, renovate, refinance technique. So it's important to continue to make a nice double-digit cash and cash return consistently, but then the exponential growth of real estate, it kind of starts a little slow. It takes time to renovate the units. Like you said, there's other things you could do. One time I had a building where the brother was on payroll, making like 70 grand a year, doing nothing. And no one knew what his job was. So he was like fired first thing, and that saved us 70 grand a year to the bottom line. Talk about hidden value add, right? And that's it. You find these opportunities to make more returns on the property. And, it actually is the asset class that's created the most millionaires, right? I think in the world, and 60% of billionaires' wealth is held in real estate. So there you go. There must be a good asset class. But you got to, first and foremost, protect your wealth, and secondly, grow it exponentially.
Yeah, 100%. I love that. I bet we could share stories all night long. I looked at a property one time where the landscaping fees were so exorbitantly high, right?
Mm-hmm.
And just the overall expense of the property when I evaluated or started to underwrite that property, the expenses were like 65, 68%. And I was like, God, why are they so high? So I'm touring the property, and the owner's there, and I start walking with the owner. And whenever you do that, the brokers get all nervous. They don't want you talking just to the owner. But
Sure.
So the owner and I walk away, and I asked the owner, I said, hey, why is the landscaping number so high? He goes, oh, I should have changed that. He goes, I pay my brother-in-law like triple what the landscaping cost is. And at the end of the year at Christmas, he gives me a check back. I go, so so sometimes if you look deep enough into the numbers and in the underwriting, you find those discrepancies or those things that you inherently start to learn about investing that don't make sense or should make better sense. Hey, we have a couple of questions.
Let's go ahead.
So Donna is asking, can a condo or townhouse community with an HOA that needs value add updates be a good investment?
Well, if I can butt in here, I actually purchased a number of condo developments because a lot of times institutional funds or other real estate investors don't want to purchase any type of real estate with an HOA. And I get that. I totally get that. But it can be a good investment. For example, I bought 25 condos out of a 31 unit complex in Paterson, New Jersey on Marion Street. And we bought it for a great price. Rents were only like 15% below market value. It wasn't like a huge value add, but then the pandemic came and rents shot up. So now rents are like 40% below market value. So it's become really a pretty big reposition at the end of the day. Now, in that case, we have 25 votes of the HOA. The other 6 votes are actually controlled by another investment company as well. So we do kind of see eye to eye and speak the same language. So it's actually a very easy relationship. And we essentially own the HOA and can override any vote from the other 6 votes there. However, I also own 14 units in a 51 unit complex in Berkeley Heights, New Jersey. Now, the reason we bought these is because in about 3 years, they're going to convert from affordable housing, which they're now restricted. They have a zoning restriction for affordable housing, meaning I'm restricted on who I can lease to and how much I can lease the units for. But that expires in about 3 years. And with a little work with the town, we're able to ideally convert this to fair market housing. And that will increase the rents by about 100% from where they're at right now after a little bit of renovation to the units and turn over the units. So that's a huge value add. And that's a nice town, Berkeley Heights, New Jersey. However, I only have 14 votes of the 51 there. And the other, votes are by just general owners of townhouses and condos in that community. And they are tough. They're tough on us. They want higher HOAs and stuff like that. So a lot of challenges there. We have had to retain lawyers sometimes to kind of, keep our rights in check and make sure we're being spoken for properly. But overall, it's been a little frustrating dealing with the shenanigans of the HOA and the egos and the crazies there as well. We have some really difficult people in that complex with really wild political views, and we have the affordable housing there. So it's like, you can't win them on the left. You can't win them on the right. Like everyone's got a problem with it. Everyone's got something to say about it. So, one side wants, less affordable housing. The other side wants more. And they're both equally as angry and equally determined that they're right, and they won't hear anything else, they're like, oh, this is great breakdown of the entire America here. So it's interesting, to deal with those HOA shenanigans. I would probably only invest in another condo complex where I have the majority vote, okay, by a long shot, like at least 2/3. I don't think I would deal with anything other than that. So in my experience.
Well, that's interesting. That's a great answer. And the flip side to that for me is I don't like HOAs. So I bought a townhouse community and I bought apartment complexes that have a portion of those complexes are townhouses. But I won't buy anything that's an HOA. I'm kind of my buy box or buy strategy is specifically market rate rent, garden style multifamily, no HOAs, because I don't want to deal with those types of issues, right? Mm-hmm. So, hey, Don, I hope that answer kind of on both sides of the aisle help you a little bit. If let us know if you need something else on that. Joanna is asking, what is your prediction? I always like prediction questions, Aaron, about the change of commercial zoning into particularly multifamily, because the demand now and ROI is probably higher in residential than commercial, like office use. And Joanna, I would ask one question around that too. Is something, are you talking about the conversion from commercial space to multifamily space in opportunity zones? Is that would that be an extension of that question, or are you just specifically talking about buying land that would be zoned for commercial, having it rezoned into multifamily?
I think she's saying, what about buying an office building and converting it into multifamily housing? That's the highest and best use of the real estate, most likely. And that's interesting because I was doing a live on YouTube earlier today, and I was reading through news articles. I started doing something new today, which is your daily real estate news briefing. So I pull up 3 articles, and one of the articles I pulled up was a company buying a large office building in downtown Jersey City for $420 million, and ideally converting that into multifamily housing, luxury housing, okay? Repurposing the real estate and repositioning it into its highest and best use. Now, that's really smart because after the pandemic, we tend to have a bit of a glut of office space now. Companies are using it less. Companies have kind of downsized. Some people are working from home. Now that's starting to change. I started coming to the office 5 days a week now. At first it was 2 days, and it was 3 days, and it was 5 days. So I think like a lot of people now are kind of getting back to the swing of things and realizing, I actually do my best work at work. I actually don't do it best at home with my family screaming at me. So actually I enjoy going to the office, so that may be a realization, but still there's an overload of office space in a lot of cities, especially North Jersey. There's a shortage of housing. So the highest and best use of a lot of these half vacant office buildings is to convert that into housing, into condos or apartments you can rent. And that's a great play right now. So we are actually looking at different opportunities like that. It is very complicated because you have zoning restrictions. You also, the way office buildings are built isn't really much like how you'd build an office, apartment building. So, it's not as easy as you'd think, but it's a really good play. There's too much office space. There's not enough housing. So find those vacant office buildings, buy them for a great price, figure out how to rezone them for residential use, and then turn that office space into apartments. And boom, you got a building that's worth twice what you paid for it or more, hopefully.
Yeah, especially if you can buy those vacant buildings at a discount, at a good discount, right?
Of course. Yes.
Hey, Donna's got a little follow-up comment on her question on the HOA piece. She said that those townhouses need roof and siding in order to keep the insurance in place, because it sounds like the insurance vendor wants to drop them. few properties have a large delinquent balance.
Mm.
A large delinquent balance isn't going to be much different than chasing somebody for rent that they're behind on. So,
Mhm.
there's always that loss to lease, right?
Mhm. Well, and I think what Don is getting at with this comment is that this is an HOA in trouble, or a complex in trouble here, where there seems to be some disconnect between the HOA fees going to the right things. I'm sure that some people are saying we need to raise the HOA fees to fix this siding and roofing, and another group saying we just raised the HOA fees last year. What'd you do with that money? You're not being responsible with the money. Same idea. We're going to raise your taxes, but we're also going to just like throw it away. Yeah, it's frustrating, right? And you want to say, well, hey, you're not being responsible with the money we're already giving you. You hired a consultant for $8,000 a month to tell us that we need to raise HOA fees by $8,000 a month. Now, maybe we should just think about what we're doing with the money. So, HOAs are frustrating that way. The problem is, though, if you have different owners throughout the complex, there's not a whole lot you could do in this case, because not everyone's going to agree to sell to you. And that's back to my initial case here. The only reason I bought those 25 condos out of the 31 is because I knew I'd have 25 of the 31 votes. I think the 14 condos I bought with the 51 votes was probably a bit of a learning curve as well. Although it was a good opportunity, good town with a zoning restriction becoming non-zoning restriction in the future, being released in the future. So, but anytime you find HOAs with this type of challenging, running out of money, roof and siding need to be replaced, those things aren't going to get any better. Roofs leak, siding leaks, that's going to cause more and more damage to the properties. What's going to start to happen is people are going to start moving out. So if you're really confident in this complex being able to grow in value over time, you can start buying one by one these units as people move out and they're just sick of it and they're selling for discounted prices. But again, you got to be careful with that, because there's obviously a disconnect in this HOA. They're obviously not putting the money into the right places, or they're not well-funded HOA. So chances are the HOA fees are going to have to go up, probably by a lot. And that's going to cause more people to move out. And that's going to cause the property values to shrink as well, because the more you charge the HOA, the less the property values will hold. So just like as taxes go up on properties, the property values can actually go down because just the numbers don't make sense anymore. So it's tough to say if this is an opportunity or not. If you can buy like 5 of the condos for the price of 3 or something, yeah, maybe it could be a good opportunity.
So, when we're talking about buying and buying strategies today, how is the inflationary period that we're in? We kind of kidded about this in the beginning. Are we in a recession or not? But we're definitely in a inflationary period where inflation's probably pushing north of 8% right now. Between that and rising interest rates, how are you evaluating deals today? Are you looking at deals, or is your pencil put down? What are you doing as a buyer today, as a buying group today?
Sure. No, my pencil never goes down. I'm always sharpening it and just getting smarter, getting more creative, right? Office space into multifamily housing. All right. Buying mismanaged buildings. But I'm also extremely cautious and aware of what the macroeconomic market is telling us right now. So one of the buildings we're buying right now is an apartment building in Bayonne, New Jersey. And the reason we like this building is because rents are 35% below market value. We got a good discounted price on it. And it's a really high demand market and a really good location. So we wouldn't be so bullish on any lesser locations, particularly right now, unless it was a great deal. We're looking at markets that really hold their value through thick or thin right now. Markets like Bayonne, that are more landlord friendly than perhaps Jersey City is, or Hoboken, right? And that's it. Also with value add, right? Rent stops growing today. Well, I could still increase rent by 35% in this high demand market. So that's good value add. That's going to take me about 2 or 3 years to do. And by that time, ideally, markets will swing back around. Interest rates might be coming down as well. So we might be looking at a bit of a better environment, maybe 3 years from now or so, as we wrap up the repositioning of this building. But I'm super diligent, more than ever right now, very cautious, trying to buy for really discounted prices with huge value add in high demand markets. That's our recipe. If I don't find that, we sit and wait. We try to do 2 acquisitions a year. We're only going to do 1 this year because, quite frankly, we couldn't find any great deals aside from this property in Bayonne, which I'm glad we found towards the second half of the year here. And I'm excited to be closing on it next month.
Yeah, good for you. So how do you, and before I want to talk about this too, but before I do, I want to know from you, how do you pick a market? What's your strategy behind it? I always call it the traps, right? I want to look at what those traps are in the market before I even underwrite or analyze a property. I want to check all the boxes. So how do you analyze the market itself before moving forward?
Sure. Well, that's one of the great things about investing in one big market, essentially North Jersey here. You know, we know our cities very well. We recognize what's going on in our cities. We see changes happening for the good and for the bad. So, you know, when you've been investing in a market for 10 years, you know it pretty darn well. And I do keep my eyes on comps. I do look at what buildings are trading at, you know, how prices are changing. But once you underwrite a market and you know what you're getting into, you know, you don't have to really keep doing it every month, you know, like, okay, this is a good market. You know, I know what my prices are. You keep track of the values and everything and rent roll. But for the most part, I know where I want to buy in these cities. I know where I don't want to buy. I know what I'm focusing on as far as, you know, the higher demand cities or the cities that are not as landlord friendly that I'm going to steer away from. And we focus on cities that are more landlord friendly. Like I'm going to buy in Bayonne over Jersey City, because in Bayonne, when a tenant moves out, there's 100% vacancy decontrol, meaning I can increase the rent to whatever the market's bearing without going in front of the rent control board. And that's a nice thing in Hudson County, because a lot of other counties there, if a tenant moves out, you have to renovate the unit, then go in front of the rent control board, show them all the renovations you did, and they'll allow you to increase the rent by a fraction of those renovations. And that fraction generally is not even enough to make back your investment in any serious manner of time. So that's really not a landlord-friendly city. So we'll focus on Bayonne over Jersey City because of that, right? And so just knowing our markets very well, knowing the rent control in different areas and how to navigate through that, we really do try to be within an hour of Manhattan. High demand markets like Patterson, Newark, you know, we're not afraid of inner city areas, but we also know where to not purchase in those areas as well, and the higher demand parts of those cities. So it's just trial and error research as well in the markets there. But that's one of the reasons I like investing in one market for many, many years, is you learn it so well, you don't have to be looking up jobs and number all the time, you know, in every new market you get into, you know.
So what's interesting is, you know, and I think there's some different perspectives around all of this, and you know, you focus on your buying strategy, your buying box, right? I have a friend who has been in the multifamily space 25 years. They have a really big company. I think they have about 100,000 doors right now, and they evaluate 1,100 markets every quarter to see the movement in the markets. Right. So when you look at it from a micro or a macro perspective, there's different strategies, right? I said, you know, 1,100. He goes, yeah, we have, you know, 13 underwriters that work for us. So, you know, it's crazy, but it's all perspective, right? So how big do you want to grow? How big do you want to get? What's your vision? What's your dream? So when I look at markets, I want to go into markets, number one, that have a strong population growth. Right. I want to see an upward trend, not just recently, but over you know, if history said the last 30 months, 36 months, I want to see an upward trend. And not just a little bit. I can't see a 0.5 percentage point move. I have to see, you know, 1.5% of that population growth growing. That's why I like Tampa, Florida. I have 1,000 people a week moving to Tampa, right? Wow. Nice. And why are they doing that? Well, they move there because of lifestyle, taxes, you know, call it red versus blue, right? We're gonna not broach that subject tonight. You know, when you talk about landlord friendly, I want to be in a state that's landlord friendly. I want to be able to do what I need to do and run my business like a business. The
Right.
next thing we look at is the job growth. The job growth is incredibly important.
Mhm.
Job growth is always spurred on by population growth because you have a demand for more service businesses, more restaurants. When you have more people in a demographic area, all of a sudden Amazon comes in and builds a new distribution center, or you have new retail centers that go up. So we look at those two things. And then the third thing, and there's a list of 8, but the third top thing is household income. So if jobs are growing, population's growing, household income needs to be growing. And why is that important? Because I want to raise my rents. So there's a formula that we use between household income and the ability to be able to raise rents that keep us, more in a positive trend, because the whole focus is how do I create cash flow and long-term wealth for my investors.
Of course.
So I have to be able to check all those boxes
Mhm.
in order for me to even look at a property. Now,
Right.
when you talk about markets, right, you could take a macro market. So like I'm going to use the Tampa, Florida market.
Okay.
There's Tampa's as a whole, but then there's 15 submarkets in Tampa.
Mm.
There's 2 submarkets I would never even buy in. And
Mhm.
I usually buy, I'm not afraid of anywhere, but there's 2 submarkets I won't buy in because there's no good population growth. The demographics are upside down. The household income is lower than the macro effect. So I need to be in those submarkets and be a little bit more granular, because then I know I can deliver the return that my investors would be looking for, or that I originally project, right?
Mhm. Mhm.
So,
Exactly.
you've kind of talked a little bit about underwriting strategy and what you look at. If you were, 6 months ago, what were the things that you looked at differently than you look at them today?
Okay, 6 months ago, I mean, 6 months ago, yeah, we were, I guess, in a little better market condition, but not really. I mean, there's a lot of doom and gloom, 6 months ago, right? There's a lot, like, what was that, May, the sky was falling, right? And so interest rates are going to rise. The market's going to collapse. I feel like we're almost like kind of just recognizing, all right, there's going to be a recession, things are going to slow down. Yes, inflation's a pain right now, but there's always so many people trying to get clicks saying, oh my gosh, the sky is falling. And I get that, it gets clicks, so it works. But I'd say 6 months ago, I was a little more sit back and wait for sure. I definitely felt the market was changing to a buyer's market, but we didn't see it in the prices yet. We didn't see interest rates really going up yet. They were actually starting to tick up then, but they weren't that bad. Now they're starting to get a little difficult to make sense of in some deals, especially when you're buying in North Jersey at a higher price. So it's been I think I'm actually a little more aggressive on the buy side now than I was 6 months ago. We were sitting back and waiting, kind of seeing where rates are going to go, seeing where prices are going to go. Prices are starting to come down a little bit, not really where we'd like to see them. I think there's just less bids on properties, which is good for us too. So I'm actually a little bit more like, okay, I am looking around. I am trying to find good deals. The last thing I want to do is wake up 6 months from now and say, shoot, I missed the buying opportunity. Now prices are going back up, whatever reason, Republicans were voted in. Now the market's on fire. Oops, I gave it away. And whatever it is.
I'll let that slide right now. Yeah.
But no, I mean, we'll see. Obviously, a change in politics there actually is kind of usually good to stir up markets a little bit and get them going in one way or another. But we'll see. There's a lot of people looking to invest wisely right now. There is a lot of still inflation pressure on rents and property values, but at the same time, you have interest rates putting downward pressure on that. The sentiment of buyers is definitely lessening, getting weakened. But man, the last thing I want to do right now is miss out on any good opportunities. I don't want to be stupid or over aggressive or over ambitious, but I'd rather buy something that, okay, maybe, you could say, oh, Was it the best deal I ever bought? Was the cheapest real estate in New Jersey? No, it was a good deal though, for a good price. And I'm going to do my renovations and get the repositioning done over the next few years while the market's a little wishy-washy. I'd rather get, decent deals than sit around and wait for like the deal of a lifetime. Because guess what? It really doesn't come, maybe once or twice in your lifetime, but it's like, if you're always looking for a deal of a lifetime, and check off every single box, that's very hard to find. Generally, if we could check off 9 out of 10 boxes on a deal and get the returns our investors are seeking, get into a good market at a decent price, we're going to pull the trigger. Whether the analysts, the experts are saying, what's coming next. And so, yeah, that's my difference, I think, between then and now.
Yeah. So, I think some of the things we're looking at differently is we're penciling our financing different. So we're increasing those interest rates and our loan to value cost, right?
Oh, sure. Yeah.
So we're changing that. And, I've lost my aggressiveness on rent growth. I mean, I've gone back to a straight 2 to 3% organic versus a real big push. So I think that those are just some of the easy things to talk about, but there's some other internal things that we dig into. But what's the thing that I'm telling investors today is you need to position yourself today on the front side of the next bull run. Because we just came out of this big bull run, right? Now we're coming down into this valley. And what happens? You come out of the valley again. It's cyclical. Real estate is cyclical, cycles over and over, just like any of the markets. But if you position yourself today in the front of that next bull run, you're going to create wealth. And that's where some of the biggest wealth in the country gets created. There's that distribution that happens every time you come out of some cycle like this. So, I just encourage my investors today, even though the return might be a little bit lower up front than we anticipated, at least let's get positioned here, because if we catch this wave, we're going to, we'll ride out of this valley and things will change and be different. So that's how we're looking at it.
Yeah, absolutely. Yeah, I also assume, inflation goes down to 1 or 2%. I assume, rent stops growing for a couple years, depending on the market, though. Every market's different. If you're underwriting something 20 minutes from Manhattan, you have to assume, eventually rent picks up again, at some point or another. And if it doesn't, then we have bigger problems than our property values, quite frankly.
Yeah, for sure. Hey, looks like we are winding down to about an hour here. Did you have, did we want to go an hour?